just saw, U.S. futures markets are higher this morning as investors have taken cheer from comments from a governor of the U.S. Federal Reserve Board. Christopher Waller said yesterday the Fed should be able to hit the pause button on rate hikes again at its December meeting, and also said the Fed may have already done enough to eventually bring the pace of annual U.S. inflation down to 2%. That, of course, is what investors want to hear. And in less than half an hour from now, we'll get economic data that may indicate further progress in the Fed's fight to bring inflation down. The so-called PCE deflator numbers will be released at 8:30 a.m. Eastern Time. Those numbers are often referred to as the Fed's preferred measure of price inflation. We'll be joined over the next half hour by a leading Wall Street strategist. She's Nadia Lovell, senior U.S. equity strategist at Global Wealth Management at UBS. And as you can see on your screen, she's joining us right now from New York. She's our featured guest this morning. Nadia, thank you so much for joining us. What is your take on the progress that's made thus far and what we may see in months ahead on bringing inflation down to 2%?
Yeah, we continue to believe that the Fed will be in a position to cut next year, and not so much because of any sort of significant slowdown in the growth environment, but more because we think that inflation will be tamer than expected. And what that means from a real rate standpoint is that the real rate will feel more restrictive than it does today. And so we think that the Fed will move to cut. As you noted at the top of the hour in terms of Waller's comment, Waller tends to be more hawkish, and the fact that he is now saying that policy currently is well positioned is also an indication that the Fed is likely done hiking and will be in a position to cut. We did see the market move to price in 100 basis points of cuts for next year as a result of those comments. We do think that that might be a little bit aggressive and optimistic, and anything more than that would suggest that the macro environment is going to deteriorate a lot more. And so we do think that the Fed is going to remain patient and really want to see a period of sub-trend economic growth. We've had a pretty strong economy this year, and right now we have the Atlanta GDP tracker for GDP now at over 2% for the fourth quarter. So you might not see that period of sub-trend economic growth until the first half of the year. And so we think that the Fed will be patient with that. And so we're not looking for rate cuts until we get to the middle of next year. And then we think that we'll get 2 to 3 cuts next year from the Fed.
Have stock markets gotten ahead of themselves at all? They've had a very, very strong fourth quarter thus far. The equity markets in the United States, largely on this narrative, largely on this growing optimism that Fed rate increases are over and cuts are on the 6-month or so horizon. Are markets ahead of themselves?
We don't think that the equity market is ahead of itself because, yes, we have seen a rally. Some of that has been driven by technical factors and systematic buy-in, but a lot more is going on than that. From a fundamental standpoint, the outlook has actually improved. When you think about the third quarter earnings season, we had a pretty strong earnings season where earnings are now back into the growing stage after contracting for 3 quarters. We did see companies beat expectations. Companies in aggregate put up 6% earnings growth for the quarter. And we think that momentum continues into the fourth quarter and into our next year. And so while they're right now, after we've had a pretty strong rally, there's more modest upside to our 4,700 price target for year end. I would say, Paul, what could drive additional upside is if we see that normalization of inflation happen faster than expected, and really that pull forward of the rate cut and an economy that still remains on strong footing, you could see further upside to earnings. So it's not just about the Fed or inflation, it's actually the economy and earnings growth recovery that's happening that could help to drive the market higher.
In less than half an hour's time, as we told viewers, we will get the release of PCE deflator numbers. That is a measure of price changes in the U.S. economy, prices paid by consumers for goods and services in the U.S. economy. You said recently that you think core PCE, which excludes, just as in the case of the consumer price index, more volatile items, that core PCE will get to a 2 handle by mid-2024. Explain that to us, and explain, if you don't mind, the PCE numbers, which I think are less well known than the CPI numbers.
Yes. And so in terms of our outlook for inflation, we do think that disinflation trend is gaining traction. fall, yes, we had, softer than expected CPI numbers. And so that disinflation has not only happened on the consumer side, it's also happened on the producer side. We did see PPI have the largest decline since its pandemic peak as well, and import prices has fallen. So when we look to core PCE, which is putting a lot of this data together to knit the narrative, it feels like core PCE should come in when we get the data later this morning, but under 3.5% year over year. And then when you look at it on a 6 months annualized basis, it's probably going to be under 2.5%. Now, remember, as you noted, that is the Fed's preferred measure. And the fact is, in the September SEP, the Fed's medium had penciled in 3.7% for PCE by the end of the year. So the point is that inflation is coming down faster than the Fed's projections. And so we do think that, as we look forward to 2024, that core PCE should come down to a low 2% range. We're even hearing from some of the retailers during the earnings season the possibility of deflation, not just disinflation, but deflation, another D word, could be on the horizon. So there are encouraging signs that inflation is sorting that normalization process back towards, the 2% trend line. It will be gradual, though.